Share this or no? Hello, everyone. Welcome. You have Akshay and Deepak here, and we have John here with us today from Goralka Law to talk about getting off the 1031 train without having to die. Welcome, John.
Hi, thank you for having me.
Go ahead. I'll pull up the slides for you. Go ahead and take it away from here.
Okay. Well, thank you. It's just sort of a little bit of a different title, but really what we're talking about here today is how to sell appreciated assets that are worth more than what you paid for them while minimizing capital gains. And that's going to become an increasing issue under the Biden administration because they're talking about increasing taxes, including possibly increasing capital gains taxes all the way up to the ordinary income rate for taxpayers with $1 million or more of income. They haven't decided whether that's net income or gross income. And when you think of all the other tax changes that are being proposed, such as having to withdraw income out of retirement accounts under the Secure Act, losing the 199A or a portion of the 199A deduction, this is going to be increasingly a very significant issue. So why should you listen to me? My name is John Goralka. I'm the founder of the Goralka Law Firm. I have a master's in taxation, over 27 years of experience. I have passed the uniform CPA exam, and I'm also a certified specialist in taxation, and I'm a certified specialist in estate planning, trust, and probate. Of the 17,000 plus lawyers in the state of California, only about 100 have both of those specializations, and I'm one of those very few. Our firm is recognized as one of the top law firms in the country by U.S. News and World Reports. And we're very proud of the results that we've able to obtain for our clients. We focus on helping successful families, business owners, and real estate owners achieve what we refer to as their enlightened dreams by better protecting their assets, minimizing income and estate tax, and providing for the distribution of their legacy to their loved ones. So here we go, getting off the 1031 train without having to die. So where did that title come from? And actually, that came from a very renowned lawyer, Joe Strazzeri, who I've worked with on a number of occasions. And really what we're talking about is many times when we have real estate investors, and I suspect we have a number of real estate investors on this call, what they will often do is 1031 out of a transaction. So that way you move from one property to the next. But the problem with the 1031 is you never, ever get to cash out. And so really what are we're talking about is getting off that 1031 train where really what they're doing is just continuing to trade properties and actually being able to cash out and at the same time minimize the check that you have to write to Uncle Sam. And so really the goal of this is not to get too technical and to help you and your clients understand and choose the opportunities that they may have. So we'll have a number of slides here. You'll be able to get a small set of those, so that way you'll be able to look at those later. And really the idea is sort of go through these quickly, so that way you can isolate areas or identify areas that may help you or your clients minimize their capital gains. And so the typical plan, the typical real estate investors, and this includes investments in tenant in common properties, which is really just another version of a 1031. And you just keep swapping. And then when you're talking about dying is that when you finally get, when you're dead, not you, but your estate will get a step up in basis for income tax purposes. And so that's what we're trying to improve upon. And then also with the 1031, you have partnership issues. So if you have a partnership or an LLC, all of the members of the partnership have to agree to 1031. And if you have some that do and some that don't, then you have a problem, and then you get into issues where it's really referred to as a drop and swap, where you have the property that maybe one partner's interest is dropped out of the partnership, But then the IRS is going to look at that, and to be safe, you need almost a year or so to be sure you're going to be protected from IRS attack. Then we're looking at appreciation, and also you have to try and avoid recaptured depreciation, which comes in as ordinary income. And then also, for those folks, dealing with estate planning, you have B trust and limited partnership concerns, and we're going to be talking about all of those. The 12 exits that we're going to be talking about include a number of charitable tools. So we'll talk about some versions of charitable trusts. We have, and as you look at that, they break out into 2 trusts, and the names are pretty descriptive of how they work. We have a charitable remainder trust, where, of course, the charity is getting the remainder, which means you, the individual, your clients, are going to be receiving the income or distributions of funds during a period of time, or for a lifetime or multiple lifetimes, and the remainder will come out. Then there is a charitable lead trust, and that the charity gets the portion at the beginning, and the remainder comes back to the family. And there's a number of advantages between that, and it's important to look at those closely. Then also you'll see a tool that's not often seen as much, which is a pooled income fund. A pooled income fund can provide significantly greater economic return, and again is overlooked. And a pooled income fund and these charitable tools are very, very attractive in low interest rate environments, which we are enjoying now. So that's a very good opportunity to take advantage of these. A lesser known alternative is a charitable LLC or a charitable limited partnership. We'll talk about the difference there. But for some of our clients, charity begins at home, and they're less focused on charitable bequests as they are on just the economic return. And we'll talk, and we'll get into, without getting too technical, there are some tools that you can use without involving a charity. One of the first that's often very much overlooked is basis shifting. And we'll get into that in particular. And that here is when we have a partnership or an LLC, and we have a low basis, high value asset. We want to sell that. There's a process that you can go through to maximize or increase the basis of that asset to be sold. And we'll go through that. We'll talk about partial gifts. So we're using a partial gift, partial sale. Then as a twist of the old B trust, there's what's called the Optimum Basis and Income Tax Efficiency Trust, which can provide a number of tools, including maximizing basis increases, how to deal with that perhaps on a formula basis, because we don't know what the estate tax rates are going to be. We don't know what the properties are going to be. And so maybe there's a way that we can incorporate a formula to do that for us. We'll talk about some things that maybe don't work as well, such as a private annuity trust, one that we want to stay away from. One that you will hear more about now is a deferred sale trust. We'll chat a little bit about that. We'll get into NINGS, DINGS, and WINGS, and no, those aren't on your barbecue. Those are techniques that you can use to avoid California income tax, which the maximum rate now is 13.3%. When you factor that in with the maximum ordinary income tax rate, for many of us, we're up over 50%. And there's just something about when more is going to the government than coming back to you that is distressing. We'll talk about a technique that with proper planning is virtually statutory, virtually no risk. It's called a 2-year installment sale. That's something to consider. We'll go through that a little bit more. We'll also touch on what I refer to as the enhanced installment sale and what the IRS position has been on that, and how to properly structure those. And so here we go. We're starting off now on the charitable tools. The charitable remainder trust. One of the advantages of a charitable remainder trust is we're selling an appreciated asset. So we're establishing a charitable trust. So then we're going to contribute a portion of that asset interest into that charitable trust. When the sale is made, the portion that's transferred into the charitable trust will not be subject to income tax or capital gains tax. So that is a significant benefit in and of itself. But yet at the same time, you will get a charitable deduction for the contribution that you made equal to the fair market value of what you gave. So what do we need to be careful about that? We want to look at the timeline on that. We want to make sure that all of the events that are needed for the sale to take place have not yet occurred. And if so, then you may be in the very unfortunate event where the asset is in charity, but yet is in charity, but you're not going to be getting the charitable contribution deduction that you were looking at because it's considered to be a prearranged sale. So the timeline can be very, very important. And if possible, you want to avoid signing even a letter of intent. We want to make sure that we have an opportunity to do the maximum amount of planning that we have. So what will happen with that especially in this low interest rate environment, right now, the applicable federal rate that you're able to use for these types of charitable transactions is 1%. And so oftentimes with these structures, to the extent that your investments are bringing home a rate of return greater than 1%, that increase is going to be flowing through to the family. Sometimes that's tax-free and sometimes not. But either way, you're getting a charitable contribution deduction and you're getting increased wealth. The difference between whether it's going to be taxable coming out or not is going to get into, for example, with the charitable remainder trust, there's going to be a portion of tax that you're paying. But when we get into the charitable lead trust, the remainder or the portion that's flowing through the family then comes back income tax free, which is a pretty nice situation to be in. So it gives increased income for the family. It provides for the charity. And maybe sometimes we might want to take some of the income tax savings, buy a life insurance policy to provide wealth replacement for the kids. A true charitable motivation is needed, but truth be told, it's really all about the number. It's all about the return on investment. And each of these trusts can be crafted in a myriad of different ways. So it's important to be working with somebody who's a specialist in this area. So that way you're not picking something up off the shelf, if you will, that may not provide the very best possible results. And so here, charitable remainder trust, the donor does not realize gain or loss when transferred. But you need to be careful because if there is debt in excess of basis, then that can trigger gain on the transfer. So again, you're going to want to make sure that you're working with your CPA to make sure that happens in an appropriate way. And again, there's no gain when the property is transferred in. And then also there is no gain when it's sold by the trustee because the charitable portion is a charity, so it's free of income tax. The result of that is you're leveraging the economic value of that because you get a charitable contribution deduction equal to the fair market value of the asset contributed, and you don't have to pay the gain that you would otherwise be paying if it was sold. So with that leverage can provide a significant amount of increased value. The charitable remainder Unitrust, that's talking about reserving the right to receive a fixed percentage of the value of the trust for life. So as that economic return or the growth in the funds in the trust changes, the distributions of rights coming to the family will change during that period of time. That's referred to as charitable remainder Unitrust or a CRUT. Charitable remainder trusts, we have the CRUTs. We have a variety of acronyms, where there are different characteristics that are applied. The key here is not all charitable remainder trusts or even charitable remainder trusts are the same. So you want to make sure you're going through the alternatives and see what works best for you and your family. We use computer programs to model how that would work. So that way you have a very clear indication of what's flowing through for your family. Another twist on the charitable remainder trust is an annuity trust, where here now you're receiving fixed payments of principal and income. And sometimes that is desirable when you want to have some certainty as to what's coming out. For those of you that are looking at, there's a relatively recent RevProc or Rev procedure which compels certain language to be used that provides greater tax benefits in this low interest rate environment that we're dealing in right now. So again, that's something that we want to look at. And again, the big reminder is we want to plan for this before the transaction occurs. So many times I have a potential client calling me saying, I have a sale that's closing on Friday. How do I avoid the tax? And at that point, all of the events have certainly occurred. And so really the major planning opportunities really would have been lost. The charitable lead trust, here the charitable component is at the beginning. And because, and backing up a little bit with the charitable remainder, the calculation of the contribution deduction that you're getting is based on the present value of that remainder interest. And so the percentage of value that's going to lead to a deduction will be smaller because of the time value of money. With a charitable lead trust, you're often going to be able to get a 100% deduction for the amounts that are going in there because the funds are going to the charity up front. And so it's important to look at that. And then also usually we're crafting that as a donor trust. I have used charitable lead trusts in conjunction with other tools that we talk about here today. We've represented lottery winners from time to time. With a lottery winner, all the events have happened for them to receive the income. So in terms of trying to get a deduction or get some of that withholding from the lottery winnings back, we're using a lead trust. That way it provides the greatest possible deduction. And especially in this low interest rate environment, it can provide a substantial return. And to the extent that we're able to receive more with the investments than that 1% that we're looking at, that's typically flowing through to the family. The remainder interest that's coming back to the family is going to be income tax free. And so so that is a huge advantage, and certainly something that you want to keep in mind with respect to that. And charitable lead trust, a lot of things can be done within that. We've even acquired real property within that charitable lead trust, and so then it helps us monitor the income that's coming in. With a charitable lead, when it's crafted as a grantor trust, you're paying income tax on the income that is earned during that lead period. So typically part of our planning is to minimize the taxable income while we're maximizing the return that's flowing through to the family. A pooled income fund is a variation. It works in a manner similar to a charitable remainder trust. You can contribute or will contribute a portion of the appreciated asset to that trust. We need to be very cautious as to how we're handling S corporations. Those are a little bit more challenging, but again, that's something we're going to want to look at. And it provides actually a greater, when you calculate the charitable contribution deductions, you're going to get a greater deduction typically from a pooled income fund than you will from the charitable remainder trust. The charitable lead trust will certainly provide that. That would be the Cadillac of devices if you're looking solely on the calculation of the amount of the contribution deduction. One of the things that many advisors are concerned about with their clients is, are they going to lose control over the investments while they're in the pooled income fund? And there are funds that will permit you to maintain complete control over that. You're able to receive all of the income from that pooled income fund. So you're getting a substantial charitable contribution deduction. You're able to get income for a stated period of years for a life, or even on a multi-generational situation. And the family is able to maintain their control over the investments. So again, it's a very, very good opportunity. The last lottery winner we worked with, we used of some of the things that we worked with, we used a combination of a charitable lead annuity trust and also a pooled income fund. The pooled income fund provided significant income for him. The charitable lead trust provided for a return of the principal or higher value after a stated period of years, and matching that up provided an excellent return for the lottery winner. Here again, we're kind of laying out how the pooled income fund or PIF deductions, you'll see that in the blue, are typically significantly higher than a charitable remainder trust during that period of time. And also notice that they provide an ongoing return, typically longer that you're seeing from the standard linear charitable remainder trust or charitable remainder unit trust. So again, you want to make sure you run the numbers on this. Next would be in our charitable toolbox would be the Charitable LLC or Charitable Limited Partnership. And here we have clients, again, need to have a charitable motive. We don't want to do just solely that. Sometimes it's not even just paying the tax. We don't like the idea of how the funds are being used, and they'd much rather have it go to their church, have it go to a social cause that they're happy to provide a result for or assistance for. But at the same time, it can provide substantial, very, very substantial economic benefits for the family. We've used these a number of times over the years. These are a long-term planning device. And again, when you have a rate of return from the investments that exceeds that applicable federal rate, it can provide significant funds flowing back through to the client, and also allows the client to continue to control the investments. And virtually all of my clients really key in on the idea of control. And just how that might work. Here we see the Charitable LLC. We have Joe and Martha. and we set up a limited partnership. Joe would be the general partner. Martha would be the 99% limited partner. Then what we do is we would be contributing 98% of the interest to a charity, and so now that charity will have a 98% interest in that limited partnership. When that happens, we're going to get a significant contribution deduction for that. Here we worked with $500,000. We transferred 98%, so you're getting a gross value of $490,000. We do need to discount that, for lack of marketability, which brings us down to $416,000. And let's just keep the math simple because it's late in the afternoon and it's kind of hard to do math in this warm weather. And so we'll use a 50% effective rate. And so with $416,000, that means a dollar savings of $208,000. So we put $500,000 into the partnership, but actually we got $208,000 back in taxes. So our net investment really was only $291,000. And then as we go through time, one of the things that can happen, and we recommend waiting at least 3, 4, or 5 years, is the family can borrow funds from the limited partnership. And so now they have a requirement to repay over time, and it'll be fully secured at a commercially reasonable rate, and they're able to invest as they wish, and any of the funds that they're receiving over and above that rate would be retained by the family. Then also what we're able to do is Joe is overseeing the investments. Joe can also receive a 1% management fee. This structure can work very, very well, but the structure must have a real current valuable interest, and the assets are permanently dedicated to charity. When I craft these, when you look at the Charitable Remainder Trust, when you look at the Charitable Lead Trust, they have formula requirements on how much goes to the charity. When I craft the limited partnership, I craft in provisions which will parallel or mirror the charitable requirements in those vehicles. So that way there is a very real and ongoing requirement in the partnership return for distributions of income that will be flowing through to the charity. So it provides very, very substantial benefits to the charity. And in particular, I have had 2 clients that we use this structure for, where they're able to profit substantially from the volatility in the stock market that we've been seeing. And this structure provided a huge rate of return for them just in this last year. So moving on, now we're going to shift gears and we're going to start talking about the folks that, for these folks from here on out, charity begins at home. We're more concerned about minimizing income tax without having to involve or contribute anything to a charity. And so the first one that we have is for basis shifting. This is for those of you that may be tax geeks, such as I am. You sit down at night, you open up the Internal Revenue Code with a nice glass of wine and the waterfall going. And what we have here is a family limited partnership. We have a parent. You'll see that described there, the parent. And the parent has 2 kids. And so parent, you'll see, has 0 basis. The 0x first is basis, meaning if he sells, every dollar that he receives is going to be subject to tax. And then he has a value of that is 100, right? And so now we have 2 assets in there. As I look at that value really should be 200, but we have 2 assets. We have asset A. Asset A has a low basis. Basis just means when let's say I sell a home to Deepak and I paid $100,000 for it, and I sell it to Deepak for $400,000, I'm paying tax on $300,000, right? And so that $100,000 that I paid for it is adjusted, but we will refer to that as basis. That's what you're offsetting the gain from. So here we have a basis in an asset that is low. And so we have a basis really of 0, and it has a value of $100. And so if we sold that, we would be paying tax on $100. And this is an asset that was purchased by the partnership, or it was contributed more than 7 years ago. And we also have asset B. Asset B has a high value, but it also has a very high basis. So here it has a $100 value, $100 basis. And what we have now is we have a partnership where we want to sell that low basis asset, and we don't really want to make a contribution to Uncle Sam for that. And so what we're going to want to do is and traditionally what the advice would be is wait for dad to die and then take a 754 election for the basis step up. That's what we would typically do. But if we know that we want to be selling that low basis asset, a better approach may very well be to make a 754 election now, strip out that high basis asset, distribute that out to dad, who has a low basis. So, and when it's distributed out, because of the 7-year, because of the parameters I provided for in the earlier slide, there's no gain on distribution. The basis is also distributed out with the 754 election. We also make an allocation under 743B. I know that's a lot of code sections, and the thing that you need to know is when we go through this process, presto changeo, now that low basis asset is a high basis asset. So now when the family sells that office building or home or corporate stock, they're going to be able to sell that with a higher basis. And whenever you hear the word higher basis, all you need to remember is lower capital gains. So again, and this is something that's strictly statutory, something that you're going to want to look at. It's not necessarily for do-it-yourselfers. You certainly want to involve your CPA or tax specialist. But quite frankly, this is often really very much overlooked. And there are a wide variety of situations where this can be used, or techniques similar to this can be used in other circumstances that really would probably take up a 2-hour presentation in and of itself. But again, this is an often overlooked approach to avoiding that capital gain. The next, we have a rental property, and so now we want to sell that. So now maybe what we want to do is move back into it. And so if I move back into it, if it's been a rental property for 10 years, I move back into it for 1 day and then sell it in a day, then I am not going to be able to avoid all of the gain on that. And remember, if it is your residence, if you are a single person, you get the first $250,000 of gain tax-free. If you're married, the first $500,000 is tax-free. But there's no exclusion for non-qualified use. So here, the rules were slightly changed after 2008. And so what we do is you develop a ratio of the non-qualified use over the total use. And typically you want to have at least 1 year in there. But again, that's something that's overlooked. And for the right client, that can be very meaningful and can be helpful. Then also what we might want to do is part transfer. So maybe we gift up and gift up to the parents and maybe get a step up when they pass. Partial may be appropriate, maybe a bargain sale. But again, using a part gift, part transfer, to a parent or older family member can provide for that desired step up at a sooner time frame and help you minimize that capital gain that you're looking at. And here, just giving you an example with generation 1 and generation 2. Right now, the estate tax exemption is $11.7 million. So transferring up to the older generation very well may not trigger estate tax, at least for many of us. But we have to remember that $11,700,000 exemption, if you're still here on January 1, 2026, and I'm certainly using my best efforts to do so, then that exemption drops to around $6 million. And then we also have to remember, the slide's missing a zero here, but President Biden and Mr. Sanders are proposing that drop to $3,500,000. So again, before we do that, we want to make sure that we're not transferring assets from one generation to the next to avoid a capital gain and then getting stuck with a 40% or possibly a 45% estate tax rate. So again, that's something we're going to look at. There's also another tool called the Beneficiary Defective Inheritors Trust, which is a OBIT, which is a variation of that, where you're establishing that and using this process through a trust. And again, that's something that can be a very powerful technique. And then also another thing to keep in mind, especially with the estate tax rates and what we have going on, is using a variation of the AB trust. And here, most AB trusts are usually designed for estate tax purposes to maximize, to prevent the loss of the first spouse's exemption through the use of the marital deduction. And so if we're not worried about estate tax because the size of the estate is too small, maybe we shift gears and we focus on maximizing the basis and step up a basis. And so again, that is an OBIT. Sometimes what we may want to do is have a formula, because we don't know what the estate tax rules are going to be. We don't know what the composition of the assets are going to be when we have those. And so using this, we might be able to use a formula provision to do that. Also, we keep thinking about basis step up, with basis always going up. But keep in mind, for those of us that were around 2008 or so, when the economy crashed, basis actually dropped because the fair market value fell. So we're going to want to be cautious with that. With the formula approach that I was talking about, it's possible to provide a formula that provides for a basis step up, but protects you from a basis step down if there's a crash due to these uncertain economic times. And again, also, we want to look at upstream planning. We talked about that a little bit before with the Beat It, but upstream planning is really transferring up to an older generation. And we often would do that in the form of a trust. And then there will be some very specific provisions we want to utilize to make sure those assets are protected, to provide for the basis step up on that older generation's death. The private annuity trust, the only thing you need to remember about that is don't do that. They were popular around 1999 through 2006. After 2006, they're no longer really effective. These are essentially installment sales to family members or controlled entity that was viewed as a step transaction. So this is something that you want to stay away from. With the private annuity trust, there was a variation on that, and that was really a deferred sales trust. You hear a lot about that. There really are no IRS rulings on the deferred sales trust. There are some concerns that I have, even from a business standpoint, losing control over the investments that are in the trust and getting, what happens if there's a crash. And also, we have to be concerned about possible step transaction or being considered as a tax avoidance transaction. These started really as a proprietary product of a investment and law firm. And one of the biggest problems that I have is access to the funds. What if a dispute arises? I'm always concerned when my client loses direct control over the assets. And so that's something that has always been a concern for me. And so moving on now, many of you have heard of these NINGS, DINGS, and WINGS. And so really what these are non-grantor trusts for income tax purposes. So what we do is we would set up a trust that exists for income tax purposes, but does not exist for estate tax purposes. And so what happens is we have assets that do not have a California situs. So what does that mean? This does not work for California real property. This does not work necessarily for a California business that has a situs here. But what it does work for is it works for stocks. It works for public securities, those sorts of things. And so what we want to do is we want to establish a trust. So it does not exist for income tax purposes. Typically, we'll have a power of appointment. We'll have a power of appointment committee made up of adverse parties. And then we have an incomplete gift for estate and gift tax purposes. Usually we have a testamentary power of appointment. We may have a non-fiduciary inter vivos power of appointment. For certain circumstances, there are a number of IRS rulings on this that permit this. This is an area that New York did not like. New York is a high tax rate, so New York legislated against these. That is something that California has indicated that they are considering doing. But if they do so, there are still versions of this technique that would be affected by the new legislation, either in New York or in if it came to pass in California. In other words, we would just simply prepare a trust that would be effective for both income tax and estate tax purposes. So that way the funds would still be outside of California's taxing jurisdiction, so long as we don't have a non-contingent beneficiary who's a resident of California. So typically what's required is, and first, virtually all of my clients want to maintain what I call dictatorial control. They want to make sure they keep control over the assets that they have. So what we would do is we would establish typically a Nevada trustee, which would be the NING. Then we have Delaware, which would be the DING, or Wyoming, which would be the WING. I typically use Nevada. And so here we have a Nevada trustee that's acting as an administrative or distribution trustee. Mom and dad would still be the investment trustee. So they're still keeping complete dictatorial control over the investments. Typically, also, we would match that up with the Nevada single member LLC to help further cement the Nevada jurisdiction and cure some of the other issues depending on the character of the assets. One of the things that you need to keep in mind is as we go through this, that we want to make sure that this is only appropriate for a client who is already in the maximum income tax rate for federal tax purposes. And the reason why is we're creating a new taxpayer, and that taxpayer is going to be a trust. For most of you on the call, the maximum income tax rate for you will kick in at around $450,000 worth of income. For a trust, the maximum tax rate kicks in around $12,700. So if we're using this technique, only appropriate for somebody who is already in and is expected to remain in the maximum bracket for federal tax purposes. And here, looking through the beneficiaries, we kind of lay that out here, mom and dad and the children. We can have a protector that may have an ability to make some adjustments with that. Mom and dad can benefit with that in a few limited ways, but they're not going to be contingent. They're not going to be non-contingent beneficiaries. And so here, we have a resident with a state income tax contributes a low basis asset to the NING Trust. The trust sells that low basis asset. At least we're avoiding the 13.3% that California would assess on that transaction. And so that is one approach that you'll often see. And so here are some examples on where that would net. And the key is the numbers, and with avoiding the California tax, that increases the net, which increases the rate of return that we would be using. The second opportunity is you create a portfolio of assets that are going to be maintained over a period of time. I did this recently for a client that had $10 million worth of public securities that he did not need to have access to for himself, wanted to provide that for his kids, did not want to be paying California income tax during each and every year. And so here he's able still to invest the portfolio. He's able to avoid the income tax on the gains, at least until it's distributed out, if it's in fact distributed to a California resident. And using the NING Trust again here, you're looking at where you're getting maybe $18,000 to $20,000 depending on the number. Here that's based on a 3% stock portfolio, 6% return. And to again keep the numbers simpler, we use a state income tax rate of 10%. That would really yield about a savings of $18,000. Keep in mind the maximum rate here in California is actually 13.3% and not 10%. So the number would actually be a little bit higher. This is a very cool tool that is very often overlooked. You'll see an article that I've written on that through Kiplinger Financial. You may want to read through that. And essentially what we have here is a 2-year installment sale. And so one of the good things about an installment sale is you pay the tax over time. The bad thing is what happens if the buyer doesn't pay the installments. So who is the best person to pay the buyer, or to be the buyer? That would be me if I'm selling. So really essentially what we're doing is we're going to be selling property for a substantial gain. It's a low basis asset. So maybe what we do is we establish a trust for the kids. And so now we fund that trust with a portion of the property that we're going to be selling. We're also going to want to have an ability to cash flow for a 2-year period of time, the amounts that would be needed. And so now we sell that, and we sell that maybe on a 30-year note. And now we have to wait because their kids are related to me. It's a related party transaction. IRC section 453E limits an installment sale to a related party if it is not resold within 2 years. So we need to wait at least 2 years and 1 day. And now the trust sales, they receive the cash, they receive the full cash payment. Yet the tax liability is essentially being paid over 30 years or 20 years based on the installment sale that we had before. So again, this can provide a very significant economic return. It provides a little pre-planning. And the problem is I very rarely have people coming to see me saying I'm going to be selling an asset in 2 years. But for those folks that are able to plan ahead, this is really a beautiful technique that can work very, very well. The next is what if we don't have 2 years to wait? What if we want to sell now? We want to maintain control. And so here, this is what I refer to as an enhanced installment sale. And it's really a combination of two things. It's It is an installment sale to a intermediary. The intermediary receives the cash sale, and then at the same time, there's a monetization loan that flows through to the client. So essentially, what is happening is they're receiving, usually around 93 to 94% of the sale proceeds net, as opposed to having to pay the tax. The tax would be due in 30 years or 20 years as you set that up, but you're able to benefit from the time value of money during that period of time. And so again, we're looking at that 30-year period of time. We have and that loan, monetization loan, is non-taxable, and there is really no effective liability. And it's not a non-recourse, but it is a partial recourse loan where the liability is very limited. So who is appropriate for that? For this to really work, for the numbers to work, you're looking at for an asset sale of at least $1 million or more. Taxes may be a motivating factor, but not necessarily the sole factor. It may be for a company that is wanting to sell and wants to minimize the tax loss to allow them to invest in other business property. So what types of assets might it work for? Professional practices, residences, mineral rights, a wide range of things. Could work for Bitcoin, can work for stock, except it cannot work for publicly traded securities. So other than that, a very wide range of applicability for that to work. Consider the installment sale rules. Under IRC section 453A, there's a $5 million cap per taxpayer. There are things, with large business sales, there are things that can be done to maximize that, to provide other 453A $5 million buckets to use that more frequently. The installment sales rules have been around since 1913. The rules are really expanded in 1998. And in 1998, if you had an installment sale, you are required to report that as an installment sale unless you elected out of that. So again, the rules have really changed. This is an example of really what you would be seeing. We would have, in this case, a $3 million seller selling to an intermediary. The intermediary purchases and resells assets to the final buyer. The intermediary receives the $3 million in cash. At the same time, we have an unrelated lender. We were getting a loan of 95% or so of the sale price. You're going to notice that they're going to be interest-only payments. The interest-only payments typically are made through a long-term escrow so that you would not be required to be paying those or dealing with those yourself. And essentially what's happening is you're selling and deferring the tax for 30 years or so. This is an example of really what the difference would be in terms of the cash at closing. Here we have a $3 million sale price, $90,000 commission. We would have closing costs of maybe $50,000, taxable income of $2,360,000. As you work your way through, you're looking at net cash of $1,634,000. And here you contrast that with the installment sale. And here you're noticing a cash improvement of over $642,000. And again, provides a substantial benefit for the family at closing. The ultimate cash tax will be owed in 30 years without any factoring for the time value of money. The term, is often 30 years. It's going to be negotiated. The repayment is typically due at the end of the term because most of the time the client's wanting to maximize the deferral. There's no personal guaranteed. It's partial recourse. So it's a limited recourse. And if the intermediary fails, we also want to have an agreement that the lender is not going to write down the loan, which would trigger a cancellation of indebtedness issue. Again, it's very technical. It ties into IRC sections 453, 453A. You'll see a chief counsel memorandum that was issued. And if somebody has an interest in seeing that, I can send them a copy. You can track that down where they address this issue. It's also been used by Office Max in a very, very large timberland transaction. Has been cited in a U.S. bankruptcy court. You'll see the citation to that there. It's something that has been around a while, but it is technical. There are two. There was a recent issuance of an analysis by the IRS that was released in May of this year, which really addresses some of the issues, but also provides a roadmap on how to handle this transaction properly. And so Once again, for those folks that don't have the 2 years to wait, it can provide a significant economic return for them. So with that we're getting to the conclusion of the presentation. To recap what we talked about, we had a number of charitable tools. We had charitable trusts. We had trusts where the charity received the funds at the beginning, trusts where charity received the funds at the end. We talked about the pooled income fund, for which for some clients can work very, very well. Sometimes matching a pooled income fund up with a charitable lead annuity trust works well. We talked about the charitable limited partnership. We also talked about basis shifting, which is direct from the code, which is just often overlooked. We talked about converting a residential rental property to your residence, partial transfers and gift up. We also talked about the Optimum basis and income tax efficiency trust. We talked about how we may not want to use the private annuity trust. We talked about we may want to be careful with the deferred sales trust. We got into our barbecue selections of NINGS, DINGS, and WINGS. We talked about the 2-year installment sale, which is, again, a statutory transaction with a great deal of potential. It just needs a little bit more lead time. And then lastly, we really talked about the enhanced installment sale, which, again, can provide a tremendous economic return. And so, again, all of these are opportunities for you. The typical 1031 does not allow you to cash out. You can keep owning and managing real properties, but it doesn't provide a mechanism for you to retire and move on. And so these 12 exits are things to consider to help you and your clients understand what their opportunities are and how they may choose to exit from their businesses or other appreciating real properties without getting hammered with the current capital gains rates. This is only going to be a greater problem because, as we talked earlier, the Biden administration is talking about even doing away with capital gains if the taxpayer has income over $1 million. And so, again, for many, many people, this is going to be a huge issue. And so we have three models that we use when we work with clients. We provide advice, we provide engagements. We often partner with other professionals. These areas are complicated. You want to have strong professionals, and we collaborate with those folks that are experts. This is a world where common sense simply does not apply. And so I think we found that partnering creates stronger engagements and creates greater benefits for both the clients and the advisors. And so with that, I want to thank you, and I'll go ahead and take any questions you might have.
John, I have a question and a suggestion as well. So you can try and answer it in a brief manner right today, but maybe the question is basically related to a pot of money. Let's just talk about $1 million. If someone was to transfer $1 million through all the tax planning possible, any kind of trust, any kind of installment sales, anything. So you would obviously look into the tax burdens, you would look into capital gains tax burden, and you would look at estate duty. So briefly, you can try and answer it now, but maybe you could do a presentation, and the topic of that presentation would be how to transfer $1 million with the least tax. And we just work with various ideas around that $1 million. Million could be 10 million for someone, 500,000 for another person, 5 million for someone else. But the thing could be replicated to some extent.
Absolutely. And I think what's really often overlooked is the process. So oftentimes people think, well, how do I minimize tax? But it's not just minimize tax. What are your goals? I mean, are you charitably motivated? Do you want the money coming back to you? Do you want to have the money coming back for your kids? If it's coming back to your kids, do we want to have any different formats? So very often people focus on some product or a tool without really thinking about really what is the goal. And so for all of that, and with that presentation, I think that will be a great presentation, but we would want to maybe go through clients with different goals because not everyone's goal is exactly the same. We have some people that are charitably motivated, some people that aren't charitably motivated, and maybe they want the $1 million coming back to them, or maybe they want that being set aside for their kids in a tax efficient way. And so, yes, that would be a good presentation. And maybe we would use $1 million, maybe 5 million, even 10 million.
Yeah, any number, $1 million. How to transfer it to your children with the minimum tax possible.
Sure. And then part of it also, it gets into their goals, but also you need to look at the type of assets, so it can get complex. And so really, for a presentation like that, really the key would be just identifying possible solutions and possible considerations on the information that you would need to consider.
So when you were talking about charitable trust, I heard that number one. What did you mean by one? That the IRS is looking for a one return? Is it 1% per annum, 1% per
Oh,
month?
so right now there's an applicable federal rate. And so with that applicable federal rate, a lot of these tools are really tied to that. So that way, the interest rate that you're using for the rate of return is 1%. So that means, let's say with a charitable lead trust, and we have investments going on, we have computer models that actually calculate that out and is tied to, the rate of return that's required. And the lower that rate of return, that lower the applicable federal rate is, the lower the amount of money that has to go to the charity, which means the higher the return, the more money that comes back to the family. So the 1% right now, this month is at 1%. I think it's going to 1.2%. So and it has been as low as 0.8 or 0.6 before. So, but even still, we're still in very low interest rates. As those interest rates rise, then the amount of the charitable portion rises. And so it affects the economics of all of this. And then the other thing I will also say is we're getting into an unusual time period where we may have rising tax rates. So if we have a charitable remainder trust, we want to make sure that we're factoring the possible increase in taxes into our model. So that way we know what the true rate of return is that's going to be coming back to the client.
And obviously, this is 1% of the assets, not 1% of the income of the trust.
Correct. Correct.
It's 1% of the assets every year. That's what has to be donated.
Well, it varies, and so the models are a little bit different than that, and so the amount that flows to the charity depends on the type of trust that we use, and the applicable federal rate is actually fed into the computer model that generates that, and so then we're able to show what the exact number is and how that number changes with the FR rates. So, but the key is with these low rates, it provides a great opportunity for all these charitable models to do very good things for charity, but have a huge economic return for the families themselves.
Got it. Yeah, it would be a great discussion to plan a kind of a meeting just around a subject of $1 million, and then obviously any multiples people can work out themselves to see how they could minimize their taxes and transfer wealth.
Yeah, that's something we definitely would want to explore in another day. That would be fun.
Sure.
Okay, well, I guess if there's no other questions, I'll go ahead and go. It was nice seeing you guys.
Great seeing you too.
Okay, thank you.
Yeah, great
Bye.
seeing you too. Thanks, John. Bye.